What a difference 3 months can make. In the beginning of April, Trump's Liberation Day tariff announcement created fear and uncertainty. At its lowest point, the S&P fell into bear market territory, declined more than 20% for the fifth time since 2009. Everyone was wondering what that meant for the economy and markets. In last quarter's commentary, we described how things could turn out better than expected. We noted that expectations were very different depending on your political leanings. Republicans felt much better about the economy and inflation than Democrats. We noted that the volatility index, the VIX, was at one of the highest levels ever. And when that happens, subsequent returns are also usually higher than normal. Not panicking, or better yet, taking advantage of times of fear, is critical to long-term investing success. As you can see from the chart below, future returns have been higher when the VIX is elevated. The following chart is another way to look at the data. When an elevated VIX invariably declines, equities perform strongly and for an extended period of time. In this case, the VIX's 64% decline over the last 12 weeks of the quarter was the biggest volatility crash in history. Thus far, in this case, the S&P is following the same playbook, staging one of its greatest comebacks ever. As of the end of the quarter, the S&P was up over 6% year to date, which is above average for the year. To be clear, we did not predict such a quick rebound in stocks. What we said in last quarter's letter was that every crisis feels different in the moment, and in some ways, this situation is indeed unique. But what remains consistent is the market's ability to absorb, adjust, and advance over time. We've seen similar fears before, including during Trump's first term, and the market ultimately pushed forward. There is still tariff and lots of other uncertainty in the economy and markets. But our previous comment still holds true. We don't know what the short term will bring, but in the long run, markets should continue to move forward. As we said last quarter, the S&P returned an average of 10% per year since 1928, despite an average intra-year drawdown of 16%. The lesson here, there's no upside without occasional downside, no reward without risk. Downside risk is the price of admission. And I'd add, resist the urge to change course because you think you know something. Some people we speak with continue to be very downbeat. Our observation is that the divide in sentiment is often along political lines. Larger surveys have supported that view. Even the views on tariffs are widely divergent. We've argued many times in this letter and in one-on-one meetings, not to let your politics color your investments. Okay. Diversification benefits, international outperforms. Twice last year, we felt compelled to defend why we continue to have international exposure. This year, we've started to see a reversal, though through the end of the second quarter, international markets had outperformed U.S. markets by over 11 to 13%. At some point in April, it was more than 16%, the highest outperformance since at least 1995. Diversification works because different markets don't always move in sync. That's why we construct portfolios that way, and we're grateful that our clients have benefited from international diversification. Housing markets and government guarantees. The Trump administration is talking more and more about ending the government's control over the ownership of Fannie Mae and Freddie Mac. The history here is that Fannie and Freddie, which together guarantee or own 60 to 70% of all U.S. residential mortgages, used to be independent companies, but everyone assumed that the government would bail them out if they ever got into trouble, an implicit government guarantee. In 2008, they collapsed under the weight of the housing crisis, and the government did indeed step in and lend them the money necessary to continue guaranteeing mortgages and took 80% of the equity. And then in 2012, the government unilaterally changed the deal, where mathematically there would never be any money left over for the remaining 20% of shareholders. While there's now some drama around whether the 20% public shareholders will gain a windfall if privatized, what's important for the economy is that they continue to be able to provide guarantees for conforming loans. Rates on mortgages backed by these guarantees will be lower if the government guarantees Fannie and Freddie's activities, whether explicitly or implicitly. This is very important as home price affordability is getting stretched. We'll watch to see if the administration gets it right. Whatever your needs, the whole SAM team is available to discuss your plan and whether it requires any adjustments. We're here to help you navigate. Please don't hesitate to reach out to us. That's what we're here for. What caught our eye this quarter? For those new to my letters, it's my custom to include some funny stories that happened during the quarter, which are unrelated to the general investing climate. My goal with these stories is to get you, the listener, to laugh. I feel like we can all use a few more laughs these days. For years, investors have looked to alternative data sources to give them an edge, but this one was new to me. Quote, the timing of Israel's plan to attack Iran was top secret, but Washington pizza delivery trackers guessed something was up before the burst bombs fell. About an hour before Iranian state TV first reported loud explosions in Tehran, pizza orders around the Pentagon went through the roof, according to a viral X account claiming to offer hot intel on late-night activity spikes at the university military headquarters. As of 6:59 p.m. Eastern Time, nearly all pizza establishments nearby the Pentagon have experienced a huge surge in activity, the account Pentagon Pizza Report posted on Thursday. Not confining its analysis to pizza, the account noted that 3 hours later, a gay bar near the Pentagon had, quote, abnormally low traffic for a Thursday night, and said this probably pointed to a busy night in the Pentagon. The X site is x.com/penpizzareport. I imagine there are a lot of boring nights watching this, but it is interesting when it hits. Some people start tech startups to change the world. Others do it to make money, yet others for the fame. Who doesn't know about Elon Musk and Mark Zuckerberg? What happens if your startup doesn't make it? And read most of them. There's always some benefit the next time, assuming you'd like to try again, to be able to talk about what you learned from your experience with future partners and investors. Even if you don't start another company, there's still some benefit to your resume. But it is better to show some success too. And if you don't have an ongoing company, the best way to show success is to have your company acquired. For a startup founder, selling your company can offer value beyond the dollars. It's the narrative boost for the next chapter. So there's a trade here. And when there's a trade, someone will do it. Quote, here is Exit Plus Plus, a startup private equity firm joke that advertises failed startup, get your exit anyway. We'll buy it for $1. Flex your exit and officially say your startup was acquired on LinkedIn, X, and your resume. There's a form to fill out to get your dollar and your aesthetic acquisition agreement. The website says reputation only deal and no asset transfer, just immaculate vibes. Yeah, immaculate vibes indeed. In closing, I hope everyone had a wonderful July 4th. And just to reinforce how interconnected we are with the rest of the world, I saw this chart, which showed that 95% of our fireworks come from China. Fireworks I saw on the 4th were fantastic. Trade is still happening. Thanks to all of you for your trust in our partnership. Your trust in the Satovsky team is our greatest asset, and we're fully committed to steering you through your financial journey. Please don't hesitate to reach out. Your peace of mind and your financial security is our priority. See you next quarter.